I'm Doris and I'm here to share with you about my stock account. Today my stock account has earned $3,801. Banks led the Dow Jones down 540 points. First claims for jobless benefits jumped to 211,000, the highest level since December. Today in my stock account, including the post-market, I have made a total gain of 6.61%, or $5,003. Right now, the net asset of my account exceeds 80,000, so the total loss in my account is 20,000 right now. Today, SQQQ made a gain of 4.545% in the market, and after the market closed, it rose for another 1.06% to 39.87. The RV rose to 50, exceeds 50, the mark of 50. It rose for 6.4% to 51.05 in the market, and in the post-market, it rose for another 1.06%. Today, the market closed down. All of the industry showed a loss, with the most from the asset and the banks. The Dow Jones Industrial Average made a loss of 1.66% to 32,254.86. Nasdaq Composite made a loss of 0.205% to 11,338.35. S&P 500 made a loss of 1.85% to 3,918.32. The U.S. stocks closed sharply lower on Thursday, with bank stocks and technology stocks leading the way lower. Markets continue to assess Powell's hawkish comments that entries could be higher than expected, and wait for nonfarm payroll data that could have a significant impact on the Fed's next rate decision. JP Morgan warned that a break in the S&P 500 fell below its 200-day moving average not long ago. JP Morgan warned that a break in the S&P 500 below its 200-day moving average could trigger a big sell-off. Bank of America, JP Morgan Chase, Charles Schwab, and other bank shares fell on Thursday. Regional banks, including Silicon Valley Bank, the worst performing Standard & Poor's 500 component, generally fell sharply. Silicon Valley Bank closed down more than 60%. Silvergate shares plunged 42% on the news that it was closing its business. Investors had already gathered a lot of data on labor market conditions ahead of Friday's much-watched nonfarm payrolls report. A better-than-expected increase in weekly jobless claims reported on Thursday suggests that the labor market may start to slow, and Wednesday's ADP private sector jobs report and vacancies and labor flow report data suggests the economy is resilient, fueling concerns that the Fed needs to raise interest rates more to slow its pace. On Thursday, U.S. investors were still reviewing the 2 days of congressional testimony by the Fed chairman. In congressional testimony this week, Fed Chairman Jerome Powell warned lawmakers for 2 consecutive days that the Fed could accelerate the pace of interest rates and that the end rates could be higher than previously expected. But he added that the Fed had not made a decision on its monetary policy in March. According to CME's Fed Watch tool, the market has a more than 50% chance for a 50 basis point rate hike on March 22nd. Main Street Research Chief Investment Officer James Dimmer said, "The market is finally realizing that a higher interest rate will continue, and that the idea of a Fed policy shift in the short term is wishful thinking." He added, "The global economy is more resilient than many people realize, which will make inflation more cohesive and raise the central bank's end rate target." Inflation has fallen, but it's far from the Fed's 2% target. So the Fed has a lot to do given the tenacity of the economy and wage inflation. Mohamed Al-Arian, a prominent economist and chief economic advisor at Allianz, on Wednesday accused Fed policymakers of issuing capricious policy guidance, saying the Fed's over-resilience on data led to market volatility. Arian said, "The Fed made the decision to lower interest rates to 25 basis points last month, and feared the bank's failure to ease market responses to monetary policy by improving the transparency of the central bank's outlook. The Fed's anti-inflation narrative, he argues, has become, we are far from the price stability leading to market chaos. He concluded, this is not the way monetary policy works. They need better strategies and structures to anchor what they're doing. Investors are waiting more news on the state of the union, the U.S. economy, including Friday's U.S. February nonfarm payroll report. Economists surveyed by Dow Jones on average expect farm payrolls to rise by 225,000 in February. Given the blowout in nonfarm payrolls in January, many economists, including Citi, expect Friday's February payroll to be a positive surprise. But the strategist Alexander said the strong job growth could mean a bad news to the market. Since the good news is bad news for the market, I think it could lead to a further sell-off in the stocks and support a big Fed rate hike. So far this week, a series of labor market reports appear to suggest that the economy remains firm despite several aggressive Fed rate hikes. This fueling fears that interest rates could remain high for a long time. Wednesday's ADP report showed that private sector employment rose by 242,000 in February, more than expected. After this week's economic data, traders have accepted the prospect of the central bank raising interest rates, more than expected at the next policy meeting. Even though Powell said the Fed had not yet made a decision on its next policy action. On the economic data front on Thursday, the Labor Department reported that the initial claims for unemployment benefits were 211,000 in the week ended March 4th, up 21,000 from the previous week's revised figure. The market forecast is 195,000. The report also showed that the consecutive U.S. jobless claims stood at 1.718 million in the week ended February 25th, also beating market expectations. Analysts said U.S. jobless claims exceeded expectations last week, but the underlying trend still points to a strain in the labor market. Initial claims were below 200,000 for several straight weeks, suggesting that high-profile layoffs in the tech sector did not have a material impact on the job market. Fed Chairman Colin Powell said a sharp recovery would depend not only on Friday's jobs report, but economists said a slightly stronger labor market would be enough. And ahead of Friday's non-farm payroll report, the market carefully watches the new budget plan released by U.S. President Joe Biden tonight. Biden's budget plan is reported designed to cut the deficit by $3 trillion over a decade, and seeks to impose a minimum 25% tax on billionaires, nearly double the investment capital gains rate from the 20% to 39.6%, and raise income taxes for businesses and wealthy Americans. Analysts recognize concerns that the budget plan could be the trigger for a massive debt explosion. But the proposal is basically a copy of Biden's multi-trillion-dollar Rebuilding a Better Future bill, with little chance of passing in Congress, especially now that the Republicans control the House. First claims for jobless benefits jumped to 211,000, the highest level since December, suggesting a slight easing in the still tight labor market. New York and California saw the biggest increases. Initial claims for unemployment benefits rose by 21,000 to 211,000 in the week ended March 4th. Labor market data showed on Thursday. The figure beat all the economists' expectations. The median economist forecast was 195,000. Continuing claims surged 69,000 to 1.72 million in the week ended February 25th, the biggest increase since November 2021. Unadjusted first claims for jobless benefits surged by more than 35,000 to 237,513. Together, California and New York accounted for 3/4 of the new additions. Severe weather in the Midwest and California could be a contributing factor. Senator U.S. Capital Markets Chief U.S. economist Stephen Stanley said, New York City school workers may also have boosted the data by negotiating the added provisions in their contracts to allow them to claim unemployment benefits during school holidays. The rise in this week's statistics was driven by school holidays in New York City, Stanley said in a report. In addition, technology, media, and financial companies have also announced tens of thousands of job cuts in recent weeks. Despite a jump in claims numbers, the labor market remained strong. Private sector jobs and the jobs opening data released this week shows that hiring and demand for labor remain solid. Data on jobless claims fluctuated every week, especially around the holiday season, and the latest figure stayed close to the presidential day. The 4-week moving average of claims, which smooths the data, adds to 197,000, the highest level since January. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.